Good afternoon, everyone. Welcome to Link REIT's 2018-19 annual results announcement. We're pleased to have our full C-suite team on stage today. Mr. George Hong Choi, our CEO, Mr. Andy Cheung, our COO, Mr. Kok Siong Ng, our CFO, and Mr. Eric Yao, our CSO. From now, I'll pass the stage to George. To questions from the webcast. So please, you can enter your questions in your webcast link, and it will be sent to the stage. For the questions on the floor, please raise your hand and say about your name and also the organization that you're representing. Shall we have the first question from the floor, please? Ken from Citi.
Hi, it's Ken from Citi. I have questions regarding your Vision 2025. So basically, just break down into several ones. The first one is, can I ask regarding your target high single-digit growth in portfolio value? I want to ask why initially set at portfolio value but not DPU growth, which is definitely more investor concern of DPU than portfolio value. And then the second question is, in setting this assumption, let's say high single digit, how many is contributed from the, let's say, the organic rental or basically the portfolio valuation growth? And lastly, does it contradict with your, for example, share buyback policy, given that if you want to grow your portfolio, that means you may inhibit, or basically you have lower intention to dispose your asset, which may be lowering your portfolio value?
Okay, we can't really give profit forecasts, so I guess this is an indirect way of doing it, and you can work out the number yourself very easily. So we're not trying to do your job here. So if you work out high single-digit portfolio value growth, if we continue to deliver the sort of return that we have from our asset, you can roughly work out what the bottom line is. Out of that bottom line, yes, part of it will be in our organic growth, a good portion of that, and then whatever is the balance is the acquisition. I think the timing of acquisition will also impact on how many acquisition we need to get in order to then deliver the organic growth from the newly acquired asset versus just buying the asset itself. I think while we set out at a certain point in time in the future, we are not a PE fund, so we are not rushing to invest and then try to sell off just to prove a value in 2025. So we are just building up the portfolio over time. So our strategy will be slightly different. It will be I think the other way to do it is while we tell you this is the CAGR, I don't think it's even. It really depends on when the opportunity comes. You know, in some year we might do a few more acquisition. In some year, nothing at all. And in some time we might dispose some asset. I mean, even disposing asset is not necessarily against this idea. You know, if we manage to sell things at a premium, it's really just one method of financing new acquisition. And I think, you know, even your point about the buyback is not necessarily contradictory. If we manage to get our equity at a higher valuation, that will actually allow us to do funding at a more attractive pricing. So we put that all together. Yes, if we do buyback, it looks like we shrink the balance sheet a little bit, but we still want to achieve that growth, which means we're working even harder than high single digit. It's a combination of a lot of things that we're looking at. More importantly, from an operating point of view, what the team is looking at is that this is actually very important for us for several reasons. One is there is a very visible target, not just externally to you, but also internally to all our staff. This allows us to align quite a lot of things that we are planning right now. Just to name one, for example, when we have 2 or 3 assets in China, we can manage it out of Hong Kong We don't need to build a China platform, China team. But when we have 5 assets, 7 assets, 10 assets in China, we really need to have an on-the-ground team. Andy from 1st of April, have taken on sort of heading the China business, and with only asset management continue to reporting to me, the rest of the setup, upgrading our IT, our HR, and many aspects in China need to be done with a very clear focus. Similar to some of the things that we just talked about in terms of facility management, IT, and all those as well. So both Hong Kong and China, there's a lot of things that we need to do to make our foundation even more solid as we build up the portfolio in terms of breadth. So those are very key for us in terms of how we pull the team together for this future target.
Carl from Bemmel.
Hi, Carl Choi from Merrill Lynch. I have a couple questions. First, given the slowdown in Hong Kong retail sales so far this calendar year, can you talk a little bit about what kind of rental reversion you are seeing for fiscal 20 based on the deals that you have done so far? Have you seen any meaningful deceleration? And second, regarding the unit buyback target, is valuation one of the considerations? Or more specifically, you have a very good problem where you're trading above your book value right now. If that continues to be the case, should we expect the unit buyback to be completed in fiscal 20 or not? Thank you.
In 18-19, the slowdown in the buyback was largely because we have quite a long period of time where we just black out. Every year we have 3 months of blackout, 2 months before final result and 1 month before interim. And then we have the disposal, we have acquisition. We have 2 announced acquisitions, but we also have other acquisitions where we didn't manage to do. So we're just out of the market a long time during the year. And so that prevented us from doing so. Whether we can get back in quickly, that's something that we need to continue to watch. So beyond valuation, just other factors that have slowed us down. Retail market, however, hasn't really slowed for our type of assets. The economy, I think for the mass market, continue to be very strong. Employment rate unemployment is still very low. Wages continue to increase. 1st of May, minimum wage increased again. So retail sales growth in our portfolio have continued to be very strong. And at the same time helped by very strong retail rental reversion in China. All the assets in China have performed very well, and we see some of the assets that we hold for some time have really increased the yield on cost significantly. The recently acquired assets have delivered very good result. We sort of gave you a hint on one of our slides saying that we expect initial reversion of some of our new recently acquired assets to be similar to some of the previous acquisitions. So you can guess roughly how high they would be. And obviously they happen after year end, so we'll probably talk about it in November when we talk about interim results. But very strong results from the 2 new acquisitions. So we're very pleased with that. And so I think in combination, we would see continued strong growth. I think the trade war have affected several things, more to the high-end retail, but for China to offset any impact to the economy, one of their tools will be stimulating domestic consumption, which is helpful for us. We have seen economic slowdown in some areas. I think banks in China have been more cautious, which means refinancing for some developers in China, some investors in China has been more challenging. As a result, we have actually seen more deals coming to the market because some of them decided that one way for them to raise capital is actually selling some assets rather than going to the banks to seek for refinancing. So we think that there are a lot more opportunities, allowing us to be even more selective And so hopefully we'll continue to find good assets for our portfolio.
More questions from the floor? Philip.
Hi, this is Philip from Bocom. Just a couple of questions about something more near term. About the key side, we have seen the leasing progress quite good. Is there any colors to share with us about the rental level or something like? What about for both the office and the retail? And then for another one, like the top mall, we have some colors to show us how the progress, and of course it's completed quite a couple of times. But is there some updates for us to know the latest progress, or on the retail podium and also the tower? And also for the buyback, if we are going to finish those 60 million shares units buyback this year, then maybe if the share price, the unit price will stay at this price, and we have to use up most of our cash. Then what about for the refinance plan for this year, and what are we going to do for this part? And I've seen another figures like the AEI part. There's quite a low yielding AEI this year, like 13.8. What was that about? And this seemed to be one of the lowest return AEI. And what about our? Is there any change to our threshold or the investment threshold for our AEI? That's my questions. Thank you.
I think Keyside, we already mentioned the progress is quite well. So both the retail and office commitment is now up to 80%. So in terms of rental rate, I think it is around the market range in that area. So we are quite hopeful that by year end, when we have all the anchor tenants move in, we should be probably closer to 100% for both the retail and office tower.
For the buyback, financing-wise, I don't think there's any impact. Our gearing is at a very low level, at 11%. So whether we will use that or other options, I don't think there's any concern in financing it. For asset enhancement, I think there's only one project where we finished below 15%. That's in the completed first half of the year. Wan Choi. We did a little bit more to it than originally envisaged, but I think in the second lease cycle that will pick up. But 35.6% on the other hand is probably one of the highest return we have achieved also in one of the projects. So we're just stretching the range, I guess. But it has been a very good year. The other thing you may notice is this is the second highest number of projects completed in a year. Last year we completed a few more. So the team have done a lot in order to actually be able to do so many projects concurrently and completed them successfully on time. So a lot of credit to our project team and our asset management team. Thank you.
Elvin?
Hi, thank you, management. It's Elvin from CLC. Just curious on your buyback. So how did you translate the around 38 million buyback shortfall to around Hong Kong dollar 2.5 cents? And if there is a buyback shortfall in FY20, shall we expect similar discretionary distribution? Thank you.
The way we have done it is we started the last financial year and we told all of you that we were committed to buying back 80 million units, and that was what's in the plan to bring the outstanding units down to about 2070 million units. And because we couldn't complete that amount, we ended the financial year with 2109 million units. So basically what we've done is that if we could have finished buying back the remaining 38 million, what could the DPU have been? So basically that's how we arrive at the 2.51 Hong Kong cents. So it's just simple mathematics, basically to return back to unit holders what is theirs that we could love to have bought back, but we couldn't because of the conditions. Starting this year, we committed to finish the balance of 38, and the remaining 22 million that brings it back to 60, that amount pertains to the recent divestment proceeds that we have allocated for the buyback. So hopefully, we would like to continue to commit, and we prefer the buyback, finish it in this financial year. If we fail to do it because of market regulatory reasons, then we will have to go back to the board to say how do we still try our best to quickly return back the money to the unit holders.
We have one question from the webcast. Just want to transfer this question to the stage first. Will you consider doing more new development after the completion of TQS?
We will. We are looking at opportunities in Hong Kong where we can do more development. We have a successful project under budget and pre-leasing very well if you compare to other development in Hong Kong. There's nothing in sight yet about what they might be, but we are studying all the upcoming potential projects in Hong Kong.
In the interest of time, shall we limit the questions to 2 more questions from the floor, please?
Hello, management. This is Hildeling from Morgan Stanley. One question about the Hong Kong tenants' occupancy cost. We see the occupancy cost has been rising from roughly 11% back in 3 years ago, now 13.5%. So, in your view, what is a healthy occupancy cost ratio, and should we expect that to be stable going forward, staying 13.5? Thank you very much.
I think we have talked about this with most of you already. The way we look at it from what the numbers, the research we have in our own portfolio, but not to compare to our peers because they are in a different sector. But for us, if you look at a portfolio in general, 15% is probably a number. When it reaches that will alert us to be looking at the reversion rate going forward. So 15% is probably the number.
Obviously, a difference depending on the trade, but if you need a ballpark number, I think we're still in a very healthy range.
Shall we have the last question from the floor, please? Jonas from Daiwa.
Okay, Jonas from Daiwa. Yeah, I have a question on China retail portfolio. The average rental reversion is 30.2. Is it possible to give more color on the performance of the 4 individual malls, or maybe also the range of rental reversion for them?
Yeah. The slide does provide an average number. I think the range of reversion of the 4 assets, given that 2 of them are pretty new, probably not too meaningful if we look back at 18-19 because 2 of them are really completed very close to year end. Each one of them have produced very good results. EC Mall and Metropolitan Plaza continue to delivering very strong results. EC Mall in particular, if you've been there recently, we've added quite a few new F&B. There's a few branded sports company have expanded space to make them flagship stores in Beijing. And Metropolitan Plaza have delivered very good reversion as well. Central Walk, even within this short time, will deliver very high reversion rate to the extent I can say. I mean, we have double to triple-digit reversion as we have underwritten internally. So we were very happy with it. Having said that, we are planning asset enhancement for Central Walk. So depending on timing, we will create some vacancy during the time when we do the asset enhancement. But for those shops that we are looking at extending the leases, they are coming back with very strong reversion. Roosevelt Plaza similarly, and I think in the next I think in 2 years' time, Universal Studio will open, some advertisement for them, if you don't mind. And the number of government department moving out to Tongzhou continue in earnest. More and more people are indeed moving there. There's not that much competition in around that area. So we are actually upgrading the tenant mix. In terms of positioning, in terms of the quality of the tenant. We are doing quite a lot also in terms of just the general asset management and property management of the asset as well. So we hope that the expense-income ratio will expand at Roosevelt Plaza. So all doing very well.
All right. Thank you very much for coming today. And if you have any questions, please feel free to contact any of our IR team, I myself, Carol, and Fanny. Thank you very much.